or my cut your losers short, and what's the rest of it?
Well, we want to let our winners run, Kurt.
Right.
Sounds a lot like buy low and sell high. If we could do that all the time, we'd be perfect.
Yeah. See, the thing is, a lot of times these messages, you know, these sayings, they seem like profound wisdom, but then they're not accompanied with the how-to. It's the, okay, what to do. This is what to do, but how to do that. That's where we normally fall short. Okay. Well, what I'm going to do, Mike, is I'm going to discuss, for example, what I believe is the opposite of what we just said, the opposite of cut your losers short and let your winners run. Mike, if you're to sell a naked put, you take as much money as you're going to make on that put at the front end, right?
That's correct. Same with a covered call position.
Yeah, same for a covered call position. So you've taken a little bit of income, and along with that income comes the opportunity to give it back and then some, right?
Yes, that is true.
Okay, so it's kind of the reverse of cut your losers short and let your winners run. In fact, it kind of sets you up for cutting your winners short, right? I mean, who hasn't had this happen where your stock that you bought and you were bullish on, but you sold a call against it, you know, to generate some income? Haven't we just seen that get called away from our account and continue on to the stratosphere without us?
Right, or it could gap up 10 or 12%, and it doesn't make any sense to roll at that point, so we get locked into our 3 or 4% gain. Okay, we made what we expected to, but we didn't take advantage of the good run.
Right, exactly. That's the point, is that we're not able to take advantage of a run. Spread trades don't allow that either, although they do allow for the cutting the loser short part, right?
If traded correctly.
Right.
You can overinvest
you
using leverage and then still get burned in your portfolio. But yes, we have a limited loss potential on the spread and a limited gain potential as well.
That's right. So it's and what Mike just pointed out is a really important principle. If you're doing spread trades, look, we had only 5% of our audience say, "Man, I'm really killing it," right?
And it was what, 68% of our audience were doing credit spreads?
No, it was 86%.
86%. I'm sorry, I got reversed today.
Yeah, 86%. Let me just check that. I'm going from memory. Let me just check that. What kind of option trading doing around? Yep, 86%. 86% of our audience is doing spread trades. Only 5% say that they're killing it. Okay, so one of the reasons for that is you've got to pay attention to position sizing, how many contracts you're going to trade.
And not only that, Kurt, but we also know that a proper spread trader, well, they're going to go further out of the money to get a higher probability of success. And what that tends to mean is, while I might be making 50 cents on a position, 50-cent net credit, going a couple strikes out of the money, but risking 5 points. So if I hit one loss, one spread goes against me, that might wipe out 9 or 10 previous gains.
Right, yeah. So you have to be right 90% of the time just to break even.
That's right.
That's ouchful. That's ouchful. Whereas on the other hand, Mike, you've seen, well, you don't have as bad a trading record as I do. I mean, you have more winners than losers, is what I mean, right?
Yeah, in general, yes.
Yeah, but you've seen me with lousy timing and lousy picks. You've seen me still win, still make money. Where I'm wrong slightly more often than I'm right, but I still make money. You've seen that. So proper money management is a real key. Okay, finally, guys, here's why I'm able to do what I just mentioned. I just mentioned that I lose more often than I win. Well, listen, if you lose nickels and you make dimes, all right, you can afford to be wrong slightly more often than you're right. Mike, if I was to flip a coin with you, and it's 50-50 chances, right? And every time you lose a nickel, but every time you win a dime, you're going to play that game with me, aren't you?
Oh, absolutely. I'd love to play that game with you all the time.
All day long. Even if it was skewed a little bit in my favor. I mean, you know, some folks believe that tails comes up more often when you flip a quarter. Some folks think it's heads more often. Well, I get to pick, okay, but you'd still play the game, wouldn't you?
Yes, I would, Kurt. Yes, I would.
All right. So the point is, letting your winners run is the way to go, and at the same time, keep a tight rein on losses. And that's what this particular strategy is about. The protective put or Mary put strategy, which is where I begin everything, but that doesn't help us with the stock that's up from where we bought it. Okay, so let's discuss how we might do that. Okay, somebody that was on the line on Tuesday, I opened it up and I said, hey folks, write in. We had folks write in with their examples of stocks that they had that were up from where they bought it. And I really appreciate, we had a whole lot of folks write in, but I really appreciated one of Carol's positions, okay? And Carol had multiple positions, but this particular one with Visa is what I wanted to use as the example. She has a cost basis of $84.60, and I checked this morning, those shares are trading at about $120. Now, she could do nothing. She could hold on and just cross her fingers. She could place a stop order, but does the stop order really lock in or guarantee her price when she gets out?
Well, no, and the problem is if she set a stop loss now, let's say 115 or at 110, sure, if the stock gradually lowers to that price in the trading day, well, she might get just closed out right at 110 or around that price. But if there's any kind of gap and the stock drops below 110 or 115, she unfortunately is not going to get filled at that price. She's going to get filled much lower.
Right. Yes, and that's what we call slippage, or if it happens during the day, or with a gap. If you don't get to your terminal in time and cancel your order before it executes, if your stock opens below your stop order, you're going to get filled below your stop order.
Sure.
You're not going to get filled at it. So owning a put is a good way to go. But the thing is, they're expensive. We're going to talk about this. Right now, Carol's got a $35.40 game to protect. Okay, $35.40 game to protect with 100 shares. That'd be 3,540, right? Okay. So how about this? How about we add a September $125 put option to those shares for 1040. Now this is in keeping with the radioactive trading principles. First of all, we're going to buy a put that's further away in time, right? Not front month. We're not going to buy next month's put option. We also go in the money. Now that's in the money, not just in the money as to her cost basis, but in the money as to what today's stock price is, right?
Right. And you got a small error there, Kurt.
Oh, do I?
It's 95, not 91.
Oh my goodness. Well, let's correct that right this second. 95. And so that's going to put my total amount at risk at 30. Thanks for catching that there, Mike.
No problem. No problem.
You can tell I cobbled together this part of it just before we press start today. Okay, so here's the deal. Okay, the total amount at risk now. What kind of risk does she have, really?
Well, it's a negative risk. Let's talk about that. We do have 95 now invested. We've got our 84.60 stock price. We're paying 1040 for this far out, slightly in the money put now compared to where the stock is. So we've got 95 invested. But we have a guarantee, don't we, Kurt? We have a guaranteed right to close our shares of stock at $125 any time between now and September expiration. So we have a negative at-risk amount. That means if the stock dropped to $1 per share, we're still guaranteed to make $30.
That's right. Now let's go back one page, okay? The amount that we're supposed to protect, whoops.
It's $34.60?
Yeah. This is what I was like.
$35.40. There we go.
Yeah. Okay, and I got that one right, I think. So the difference is $5.40, right?
That's right. We've got a difference of $5.40.
Because what we're doing is we're locking in 30. Okay, so the difference is $5.40. Well, where's that $5.40 difference coming from? Well, let's think about it. The stock is at 120. The put is 125. Now, $5 of this price is intrinsic value. In other words, $5 of it is going to definitely come back to me. right?
That's right.
The only thing that I'm really putting at risk there is the $5.40, okay? And so this is actually from last week. We've got a graph that looks like this, where we have the familiar hockey stick graph of a married put, but there's something missing. What's missing?
Well, there's no loss.
Right.
There's no red. There's no break even.
There's no break even. There's no place at which you are losing, okay? But wait a minute, you might be saying, I don't want to spend $10.40 freaking cents on insurance. That is not sexy. That does not seem like a fun thing to me to do. Okay, right? Okay, I get that. But first of all, I think I already told you that
We're really only paying $5.40, right?
Yeah, that's really all that we're, and the other $5 we're paying, but we're not paying and never going to see it again. We're putting it on deposit. Right?
Mm-hmm.
It's going to come back. So what about that $5.40? Well, how about we finance that? How about we finance the cost of that? How could we finance it, Mike? What's one way?
Well, we could sell a call against it, couldn't we, Kurt? That's common. That sounds sexy. If I own stock, why don't I just sell a call against the stock, generate some premium?
Right. That's what a collar is, for example, where you buy put and also sell a call, and you end up kind of trading in a certain range, right?
Mm-hmm.
But so I wanted to emphasize the cost isn't really $10.40. Some of that's guaranteed to come back. So $5 of that $10.40 is intrinsic value, so $5.40 is all that you're really asking. So, and with props to Monty Python, I'm going to say now for something completely different.
Mm-hmm.
Most folks don't realize that you can nest one trade within another and take away from the risk of both. I'm going to say that again. You can nest one trade within another and take away from the risk of both. So what are we looking at here, Mike? This is a particular spread trade that looks to have infinite risk. And I call it the money net. What does most of the options trading world call it?
Well, it is a ratio call spread.
That's a ratio call spread.
Right, general 2-to-1 or something along those lines.
Right. That is what I'm showing is a 2-to-1. Okay. Here was my idea. I had this idea back in, oh gosh, I think it was 2004 or something, when I was continuing to explore ways to manipulate a married put. Okay, you start out with a married put. That's a good way to start a trade, so that you limit your downside, but you have your upside completely open. And then within that, you could also do these little miniature plays. Well, in this case, Mike, today, this morning, the July $125 calls were selling at $3. They're probably close to that right now. And the July $120 calls were selling at $5.50. Now, 3 minus $5.50 is not 50, okay, but 2 times. See that? That's 2 times. Two calls. If I sell 2 July $125 calls at 3 apiece, I'm going to bring in $6, right?
That's right, $6 total premium.
Now, let me use some of that $6 and buy with it a July $120 call for $5.50. So what am I left with?
Well, 50 cents again.
50 cents. And I'm also left with an obligation to deliver stock. All right. And if I do this plain vanilla, if I do this just by itself, I have an infinite upside risk. And how come? Why is that?
Well, one of your short calls is naked. You've got 2 short 125 calls and a long 120 call. So if the stock gaps up, well, your 120 call is going to cover one of the calls that you sold, but the other one still has infinite risk. So if the stock went up to $200, well, one of your 120 call will cover the other 125, but with the stock trading at 200 now, you would have to go out and buy shares of stock at $200 to deliver the obligation for the other call at 125. So that would be a $75 loss.
Wow. Yeah, that's not good. $75 loss on 100 shares is $7,500. So we don't want to go there, so to speak. See all this red down here, Mike?
Yes.
What does this? Why is this red here? It's here because I don't have the stock on hand to deliver, right?
Right. Right.
But what if I did? If I did have the stock on hand to deliver, would any of this red be here?
Well, depending on the cost basis of the stock, but essentially no, Kurt. You wouldn't have any of the red on the downside there if the stock continued to move up in price.
Right, that's a good point, depending on the cost basis of the stock. Let's say I bought the stock at below whatever this strike price is here.
Right, right. Then no, that would negate any of the red that you have remaining on this spread.
Right, and Carol happens to own her shares of V. It's Visa. She happens to own her shares of V at a lower cost basis than $125. So we could, now again, I'm not making a recommendation, and Carol, just because you gave this to me on Tuesday and hopefully you're tuning again today, I'm not giving you advice, okay? But I'm making an observation. I'm showing you something that is available to you. And that would be to pick up 50 cents and not have any upside risk. The objection comes, doesn't that put even more at risk? You know, the 50-cent credit is nice, okay, Kurt, but it comes with infinite liability. No, it doesn't, not when you own the stock, okay? So here's what that position would look like, all the legs that we discussed, okay? How about Carol's stock plus the put option plus the ratio call spread? Well, using the power options tools, this is what we end up with. Mike, there's something missing from this graph also.
There's no, again, break even. There's no red, and there's no loss.
Right. The maximum risk is a negative 29.7%. Okay? We've got a negative 29.7%, and that's going to happen if the stock crashes. Okay? If the stock absolutely crashes to the floor and it's trading for 1 cent tomorrow, well, will Carol be pleased that she made the $10.40 investment in her put option?
Absolutely, because she'll still be locked in that gain of the 29.7%.
Yes. She'll have the privilege at that point to sell her stock at $125 a share, regardless of where it goes. Okay. She will have taken a 50-cent credit on that ratio call spread, but I'm interested more, Mike, if the stock trades sideways or up a little bit. You know, it's at 120 right now. If the stock goes to 125, what happens to those call options?
Well, they're going to, excuse me, if the stock's at 125, your two 125 calls will expire worthless.
But the 120 call is going to be worth something, right?
That's right.
It's going to be worth $5. All right. Now that's the best outcome, or one of the better outcomes, okay, of this play, is if the stock approaches or gets to exactly $125 a share. Those $125 calls expire worthless, but the $120 call is worth more than I paid for it.
That's right.
Kind of cool. Okay. All right. So one thing that a lot of folks don't get is that you can often close a ratio call spread at a credit as well. You can. This is really interesting. This spread, out of all the spreads that I've seen, this spread and perhaps also the broken wing butterfly, okay, another advanced spread technique. Okay, these are techniques that if you apply them, you can get paid to open them, and you can get paid again when you close them. Here's why. If your underlying goes down, let's say, Mike, that the underlying stock goes down before expiration to $115. Those $125 calls are going to lose value much more quickly than the $120 call, right?
That's right, Kurt.
So I'll be able to close them at a very, very small amount, but I'll be able to cash in my 120 for something because there's time value. It'll still be worth something. Okay, and a lot of folks don't get that, but the fact is, you put on a ratio call spread, you've got a very good chance of getting paid again.
Absolutely.
Yeah, it makes for awesome management opportunities. Okay, well, what if she goes sideways? Well, say we do hold that money net play all the way until expiration. You got paid to put it on, and you have the stock on hand, so there's no risk for adding that call spread, right? No risk to your capital. But you get paid again, Mike, at any of these strike prices, anywhere between 100, or I should say ending prices, okay? Anywhere between $120 and a penny to $129.99, we're going to get paid a second time. Ta-da! That kind of bowls me over, okay? Because here's the thing. That $120 call is going to be worth something at expiration anywhere that the stock finishes between 120 and 130. Kind of cool.
Right.
Right. We may need to deliver stock, but we may avoid delivery of the stock by rolling one of those short calls. That's kind of cool. If we do roll one of those short calls into the next month, well, what we're going to be left with here is a bull call spread that closes in the money for $5. So we picked up 50 cents, and then we're going to pick up another $5. And the fact is that $5.50 would pay completely for that put option, wouldn't it, Mike?
That's correct.
Yeah, happy day. Okay. The income methods reduce the break even when you open up a married put from scratch. Okay. And what they can also do is they can capture enough to completely eliminate the costs that we put into a stock. I'm sorry, into a put. Okay. So here's the deal. If Carol's stock goes down, she will be happy that she picked up the put, right?
Correct, and she generated a little bit of premium along the way to help finance some of that put the time value cost. Excuse me.
Right. If it goes sideways, if it ends up anywhere between $120 and $130 a share, she's going to get paid a second time. She got paid 50 cents to put on the ratio call spread, and then she'll get paid a second time. A maximum of $5. Maximum of $5, but it could be as much as $5 more. Okay. And then the money net is going to capture as much premium as she spent on the put option, and there's management opportunities to this too. She could continue to roll and grow this thing. Okay, so once we reduce the gap to less than 0, now we're going to be bulletproof. Okay, we're at a place where we own an option that protects our stock, but we haven't paid anything for it.
Real quick, Kurt.
Go ahead.
Paul brought up a point. And he said, well, fundamentally, this doesn't seem right. And what he meant was, he didn't say that exactly. I'm kind of paraphrasing for him. As a fundamentally, this didn't seem right. You're going against your own rule. By doing this, you've cut the winner short. And that's true. Or not cut the winner short, but you've capped the gains there in that case. You saw that. You had mentioned there are ways to adjust it. But, and that's true, if you use the true 2-to-1 ratio as described in the blueprint against your shares of stock. However, if I happen to own 200 shares of Visa and I went to put on this play, if I only sold 2 calls and bought 1 instead of selling 4 and buying 2 calls, for example, if I only sold 2 and bought 1, we still generate that 50 cents of credit. We still have the $30 per share guaranteed profit, but now the upside is not capped because 100 shares of stock are not covered and can continue to grow in price. So, Paul, you're right, but that's fully described in Kurt's full work there. And then he followed up with, but what if the stock continues to go up? And there's adjustments. Kurt was just kind of talking about with that as well. You can actually close it for a credit in some situations because of the value of the bull call debit spread that's now in the money, and manage it with what we call income method number 2, which is also discussed in the blueprint.
Right. Let's, Mike, let's quit making references to the blueprint because I did want to make sure not do any kind of sales pitch or anything today. I know you're. It's okay, but yeah, the point is his point is correct. If we have 2 short calls and 1 long and 100 shares of stock, then we do in fact cap the upside. We cap the upside with an extra captured premium. You know, you're going to do better than with a covered call if the stock goes up. But there are ways to construct the same deal. And one of the questions I get a lot of times with this particular play is, can I do this in my IRA? I only have level 1 options trading clearance. Well, guess what? Yeah, you can with a certain set of circumstances. Okay, if you have 200 shares of stock, yeah, and 2 puts, then you do 2 short calls and buy 1 long, You can do all that with low one trading clearance. It's kind of cool. You'll end up doing basically a ratio call spread, and you'll also have your stock, your upside position unlimited. Now that's really difficult, I think, for most folks on the line to visualize, and I didn't prepare a slide for it.
Mm-hmm.
But I'm glad that the question was brought up. So let's recap for Carol's deal here. What had been the problem? Okay, the problem had been that she had an $84.60 cost basis, and the present price is $120, right? She's got no guarantees. Today might be the highest Visa ever goes, and it's a tumble from here. On the other hand, today might be just a new chapter in the Visa saga, and Visa is going to go to $200, $300 a share. Who knows? I don't know that. So the problem is she's got no guarantees. But why don't we maybe think of building a fence around the stock with options? Now, Mike, one of your favorite plays is income method 4, where if the stock does go up, you're able to roll and continue to get higher and higher put prices.
Guaranteed exits, absolutely.
Yeah, and pay for it by exiting the old put.
Mm-hmm.
So is it possible to Carol that she could also employ something like that, where she could just set a higher and higher level, but not with a trailing stop, with something that's ironclad?
That's right. And then the caveat, of course, with income method number 4, Kurt, is it doesn't sound sexy because it's typically done at a debit. I'm putting more into the position, but by putting more into the position, let's say $2.50, maybe $3 in the position, I'm guaranteeing myself a $5 higher payout. So it's a conservative approach, and I am paying more money into the position, but for a better guaranteed exit and higher bulletproof, for lack of a better term.
Will be more and more bulletproof. Folks, on Tuesday, that's what we're going to show next. We're going to show bulletproofing with income method number 4. Okay? Let's see. So what's possible? What's possible is you can build a fence around the stock with options. Part of that fence that we're building around it is the put option. Okay? Part of it is the ratio call spread, where you would grab 50 cents now and maybe grab more later. Now, I want you to remember that the put option that we picked up in this scenario was a September put, and we're selling July calls. So, Mike, come August, are we going to be able to sell August calls? Or are we going to be able to sell September calls if they're offered?
Absolutely. You're going to have opportunities to do this position again to further lower the risk or generate a little bit, well, I shouldn't say lower the risk, but in the case of a non-bulletproof married put, to lower the risk and then generate more profits. That's
right. So what's different for Carol's position? Well, she may cash in that stock at $125 because it's a $125 put we're picking up. She may cash it in at $125 no matter what happens to the downside. Okay. She can continue to play those ratio call spreads in July, in August, in September. Okay. And before, the stock was unprotected and stagnant. Now, the stock is going to have a nice warm overcoat, that put option that protects it in case of a downturn, but also an intriguing possibility. We might capture more by using those ratio call spreads or other income methods. We may capture more, and this isn't a guarantee, but it's certainly a possibility. Capture more than we spent to protect the stock in the first place. Kind of cool, okay? And Mike, this is what the chart looks at. You see here from 120 to 125 that there's an accelerated period of growth.
Yeah, that's due to
how do we explain that?
Well, it's due to the bull call spread aspect. If we look at it the other way, the ratio call spread is essentially trading a bull call debit spread and a covered call in the same position.
Right.
So as the stock moves up to 125, we're not only gaining on the stock, but we're also getting an increase from that long call option that we were essentially paid to own.
I like the way that sounds. We were paid to own it. And it's true. You sell 2 calls by 1 at a credit, which is possible to do with a lot of different stocks. It's possible to do it with Visa today, at the July $120/$125 range. You can sell a ratio call spread at a credit and perhaps pick up more as it goes. Kind of cool. Okay, so Mike, that was what I wanted to share today, and I thought that if folks wanted to take a look at it, we could even go on power options and look at those positions again. But folks, if you'd like, I'm going to point you out to a free resource. Okay, if you'd like to pick up a couple of weeks free of power options, the platform I'm going to use here in a moment to run through this again.
Mm-hmm.
If you'd like to pick that up for free, it's www.powerup.com/RAT. And I'm going to send that out on the, whoops, I'll send that on the chat line, powerup.com/RAT. And presto, changeo, we're good. Okay, and now I think we're on power options.
Mm-hmm.
Is that what I'm showing up there, Mike, or are you seeing the screen and it's...
Yeah, can we walk through something? I know you have the, what do you have? Oh, you just have the ratio spread up here. Okay, I see that.
That's just the rate. Did we want to try and answer, what was the name of that fellow that had the question about the cap and the upside?
That was Paul.
Paul? Okay. Why don't we talk to Paul about how this would look. First of all, we'll do 100 shares. What was the cost basis? 84.60?
84.60, sir.
84.60. Okay. And at the same time,
We're going to go up to the view options link.
Yep. And we're going to pick up a September $125 put, right?
Mm-hmm.
Okay. Oh, it's more expensive now.
Well, the stock's dropped about another 80 cents. It looked like it was trading at about 119.11 or so, so it was no longer at 120.
Okay. Well, why don't we use the numbers that we started with this morning?
Okay. 1040.
Just to make the math clean here, 1040. Geez, you know, we would have been happy that we put that on this morning.
Yeah, see, when you did it, it was at 120.45. We can see that right there. And now Visa is trading at 119.24. So it's dropped about $1.20 since you looked at the original trade.
Wow. Okay. All right. So, Mike, at this point, this morning, we would have locked in
29.7, was it?
Well, I don't know. We definitely lock in about $3,000 worth of return, and have this opportunity of this ratio call spread doing better for us. I should mention, of course, that that put price has gone up as the stock dropped, and the ratio call spread you could conceivably close for less than you close it and get paid again, conceivably, as the stock goes down. It's just a really wonderful phenomenon. But let's do this, Mike. Let's make it 2 puts.
Well, let's scroll down to the chart real quick before you submit that. You can leave that there. It doesn't matter until you click submit. But let's just take a look. Now, let's say that we were in this position, and let's say that we wanted to protect. Good, we did that. And we like this idea of this ratio spread, as you mentioned, of course, but maybe our expectations were the stock may go up to 130 or 135. Now, this is the opportunity where this could still be a very useful income method to use, but you may want to be cautious of using the full 2-to-1 ratio against the position. And that's what Kurt's going to show now, is if we had 200 shares, how would this look?
Right. Okay. So if we bought 200 shares and 2 puts to protect it, and only did the single ratio call spread, 2-to-1 ratio call spread. So now we've got 2 shorts, 2 short calls, 1 long call, 200 shares, and 2 puts. Okay, so we submit that, and we're going to end up with an unlimited upside potential, but a period of accelerated growth.
Yeah.
See that? We've got unlimited upside potential, right? Maximum profits infinite. But this zone here from 120 to 125, it picks up, again, because of being paid to ownable call spread. Right here is where the liability of one of those calls, one of those short calls takes over. And again, we might roll it. Okay. But the fact is we've got more long than we've got short, so we're still unlimited upside.
That's right.
200 short, 200 long, 2 short,
1 long call.
1 extra long. Yeah, so we're more long than we are short, and so guess what? We don't have a capped upside anymore.
Mm-hmm.
That's kind of exciting. So yeah, that's a variation of income method 5 or the money net.
That's right.
Trade.
That's right.
Cool. Okay, other questions? Paul had a good point. Other questions there, folks? We've got about 5 minutes.
Yeah, Lloyd is one of our radioactive traders, and he just wanted to point out that he thought we should make people aware of that. When they looking at that, just remember that it does cap the gain there at the upside, but there are ways that you can do this where it won't cap the gain. And this is just one example. Another way to go is perhaps income method number 6, which we showed on Tuesday, which is a possibility once you bulletproof a position that you can leave the upside open, for example, but still generate a credit up front.
Let's do that. We'll do income method number 6. What we'll do is sell the lower strike and buy the upper strike. We're going to generate a credit when we do that. Let's find out how much it is, because the Power Options platform will go out and grab the natural ask price, right, on this 25 call, and it'll also grab the natural bid price. So looking at this, it's going to generate, Mike,
209.
$2.09 in credit on each play, on each spread. So a total of $418 into the account. Did I already submit? I submitted. So Shazam! Look at that.
Okay.
Again, no break even. Kind of cool. And our short calls have brought in some income.
That's right.
At a certain point, those short calls represent an obligation.
And the long call,
during which the put is going on. But then what happens, Mike?
Well, then the long call kicks in again. So we may still be obligated to deliver shares at 120, but we have this 125 call that we were again paid to own. So if the stock does gap up again, goes up to 130, 135, 140, we have unlimited risk.
Yay.
Oh.
You would do this if you're a little more bearish on the stock. The ratio call spread, the money net that I showed, is you're more you're more short-term neutral or short-term slightly bullish.
Agreed.
That would be the reason to do that rather than income method 6. Okay, other questions?
Well, we had a comment just saying from Steve. Steve and I were having a discussion about, what he had an income method number 5 before. He's one of our radioactive traders, and he didn't get whipsawed per se. What happened is that the stock fell, and he ended up buying the close the calls and selling the close. Buying the close the calls, and then he was expecting it to continue to move up, but it didn't. It continued to move down. It moved down, then it whipsawed against him a little bit. So we were talking about, saving the commissions, maybe just waiting closer to expiration, letting the position expire. But he just wanted to comment as well that this is what happened to him on a Starbucks position. He bought back the short calls thinking the stock was going higher after a pullback, but it just kept going south. The long 62.5s expired as well, but captured some profit on the buyback. Was contemplating selling another call, and he's looking for another opportunity, but in general, he's just glad that he has the October 60 puts, and he says, much thanks to Kurt.
That's about Yeah, very good. That's what I was going to ask. I said, I was going to say, are you glad that you had the puts in place? Is that Steve S?
Yes, that's right, Steve S. Yes, sir.
All right, yeah, Steve, I've been trying to reach you there, buddy. Give me a call when you get a chance. I had hoped to speak with you before expiration on in May. Okay, what else have we got? Well, I guess that kind of covers our subject today. The subject essentially was a different way, another way of bulletproofing, and I wanted to ask folks online, hey, look, if you could bulletproof your trades using the technique that we showed or something like it, would you? Would you want to? And on Tuesday we had 92% say yes, and it's shaping up very close to the same today. So let me go ahead and close that, folks. It's been up for more than a minute. And we have 3% saying yes, they would do it. Okay, and the remaining 7%, you know what? There's other options. Not to make a pun, but on Tuesday we'll be showing yet another bulletproofing option. And I think this time we'll start from scratch. Instead of taking somebody's stock that's up and then building a fence around it, what we may do is we may just show a position that starts from scratch. Starts from, hey, I want to go long. I want to buy a stock, but I also want to protect myself. So here I am getting into the stock and the put, and then what could happen after that. So well, that's the forecast for Tuesday. Radioactive traders, I'm glad that you're here. Mike, as always, I sure enjoy presenting with you, and it's a lot of fun. I gave everybody a link to Power Options where they could get a 2-week free subscription. Go ahead.
Hold on one second. There's another question that came in. Before we do that, I want to show something else. Can you go back to your screen, Kurt, and go to Power Options? We're still showing the poll right now.
Oh, okay. Hang on just a sec. Go to Power Options. Okay.
Okay.
Am I showing it? Is it?
No. Let me hide the poll for you. Let's see.
I see it. Okay. I was flipping around there. Okay. And what do we want to look at?
Okay. Go to the Married Put tab for me. So if you guys take advantage of that offer that Kurt sent you, the 14-day free trial at powerup.com/RIT, click on the insurance tool there, Kurt, under the Married Put. So when you log on, you go into Married Put, you go into insurance. Well, instead of using the, Kurt can see these things right off the top of his head. He knows which put he might want to use if someone sends him a stock symbol such as Visa. Let's put that in.
Okay.
And let's put in the cost basis of $84.60.
You know what? I didn't use this tool, but I probably should have. It'd be quicker.
Right. Now you can hit calculate. It's in all months, and this will show us all the available months. But as Kurt said, we know that we're not going to want to go and buy the 30-day out option, even though that locks in the most time frame, the 23-day out option for June, even though that locks in the most profit. We're going to scroll down on this list and find that 120-day range or maybe 200-day range that we want. So we see the first one that's around, that $110, $120 range is September. So what I might do now, Kurt, is just scroll back up to the top and change the expiration month to September. Instead of looking at all the different collections, I just want to compare the September series. Perfect. And we just hit calculate. Okay, so if you have a stock that's moved up in price, you take advantage of that 14-day free trial. You want to use this insurance tool here to see the different prices and what your locked-in profit is. And you see some of the ones there. You've got 135s, 140s. And, just in general, these do lock in more profit because they're deeper in the money. But what we typically discuss here is it's not only just about locking in the most profit. You want to ask yourself, what put strike makes the most sense based on where you think the stock might be trading in the next 30 to 60 days. That's why Kurt kind of focused on the 125 instead of the 140 or the 130 or maybe going to the 110 or the 105. That's why we're in that range. Now, once you've done this, you start your trial. You go to the insurance tool. You put in your stock and your cost basis. You evaluate your month. Click the little blue button, Kurt, our more information button next to the 125 put there for September. Oh, no, further down in the chain there on the results. I'm sorry, Kurt.
Oh, I'm sorry. Where am I going?
The 125 put. 125.
125 put.
That's the one we bought, right? Yep. Click on that and go to profit and loss chart.
Okay.
And see, now the numbers have been crunched for you. And we've got the Married.
Right there.
It takes you right there with your cost basis and your put. And now you can start evaluating, what if I did that income method number 6? Let me click on the options from the View Options link. Or what if I did an income method number 5? This will help you run that what if scenario. But the starting point, if you have a stock that's moved up, if you take that trial, go to Married Put tab, go to Insurance, put in your stock symbol and your cost basis. It'll do the crunching for you, and then you can come to this field directly from there to evaluate other adjustments you might make against it.
Mike, I'm glad I came today because now I know how to use Power Options a little better. That's cool. So I could have gone to Married Put and go to Insurance tool, and then add my stock symbol and cost basis, and that'll figure it out for me.
That's right.
That's awesome.
Yep. So that's the starting point.
Okay. Well, thanks.
A lot of times when I talk to a customer on the line, I show, or during a coaching session, I show them this. But I always start with all months because if someone gives me a stock. Well, you've got another one that was sent in, MNST. Well, I don't know the expiration dates on MNST off the top of my head, so I just go from scratch. And I start with all months, and then I just scroll down that list and say, well, which one's at least 120, 130, or maybe 200 days out in time kind of thing.
Right. Very cool. Very cool. I'm digging it. Well, cool, Mike. All right. folks, I want to thank everybody for coming, and I would like to invite you again to come on Tuesday. We're going to do another, but this particular one will be a historical
Right.
trade, so I can show you the management of it, and I think you'll really dig it. So, Mike, thanks for being here, and thanks for showing me that little tip on using power options.
That's what I'm here for.
Yeah. Yeah, that's right. You're the guy to go to. I'm going to flash up this screen last time for folks that might want to take advantage of that free resource. And we'll leave that up for a few moments and then sign her out. So thanks for coming, and happy trading, everybody. And we'll see you in a couple days here, Mike.
Yeah, and just real quick, if you think of a question later, or you send in a question just at the last minute and I haven't gotten a chance to answer it, by typing, of course, just send us an email to support@radioactivetrading.com, and we'll be more than happy to answer your question there.
Cool. I'm sending that out to everybody in the link also.
All right.
Support@radioactivetrading.com. Okie dokie. All right. Thanks for being here, everybody, and we'll see you out there, and happy trading.
All right. Take care, everyone, and have a great weekend. Have a great holiday weekend, Kurt.
Thanks. You too.